Hello and welcome to today's video. In this video, we'll see what makes an investor take a trade decision which is against the common beliefs that are available in the market. We'll also see how a trader takes a trade by focusing on the price of the security. We'll also see why selling a stock at a lower valuation may or may not be a profitable deal for your portfolio. So like this video right away and subscribe this channel so that this video reaches a lot of people. See, buying low and selling at a price higher than the price you have bought it is a very common fundamental for any profitable transaction or any security transaction. So it's not different for the stock market too. Now we have heard, seen, felt, been through every moment, every tension that the market has given us to find out the best moment to buy a stock and the best moment to sell it for our own profits. So by default, the buy low and sell high is a virtual mantra that has been in the market for like generations after generations, and it's been passed on to us for free. If you're in the stock market for a long, you would know, you have witnessed how influenced we are by the noise that are around us. People giving us their opinion, the news channel, they give us their opinion, so on and so forth. The big noise from the media, they create an havoc in your mind, and how these small information, which we call it as noise, they play with our mind to force and take a decision which is against a proper, channelized, researched decision. Let's see how we think. Just take an example. When there is a panic in the market has fallen a bit, everything is in red. You say, okay, good, the market has fallen, that's fine. You become optimistic and start thinking that, well, the market is going down, so let's wait. It's time to buy more, let's wait for the market to fall a bit. Good thinking. The market starts going down further. You start feeling it's great. You start piling up your money. You wait for the right moment to come. But the sad part is you never reach the point. You never reach the point of entry. You never get to decide at what point should I enter. Instead, a time comes when you start to feel differently. A different fear takes over your emotions. What is it? You start thinking the reverse. Instead of piling up your stocks, you are now afraid of your existing portfolio. You are now afraid of the stocks that you already have and the losses that they have made. Now, instead of buying more and averaging it out, what you do is you start fearing losing more wealth from your portfolio. You start panicking on your existing investments. And to spice up the wound, the news channel add terror to this downfall. You now have fallen for the trap. You start anticipating a major loss to your portfolio. You now start anticipating a further fall in the market. Now what you do? You stop buying and start selling off your existing shares to prevent a further loss in your portfolio. The exact opposite thing happens when the market is on the rise. You wait with your portfolio to sell at the very top. But unfortunately, nobody knows where the peak is. So you never get to a point and decide when to sell off. And by the time you scratch your head to find or get to a decision, the market has gone up substantially. Now, the more the market goes up, the more they come in the news. People get excited. Everybody wants to be a part of this joyride. Everybody now wants to buy. But unfortunately, the market has gone up substantially already. And what you do is you land up paying a premium for the price. They buy the security when the stock is already trading at a premium. Now, if you rewind this video and listen to it once again, hopefully you will get to understand what is happening with an investor when he is in the market. I'm sure you can, but if you still cannot, let me help you. What you're actually doing is you're focusing on the price of the security. And the price movement is the driving force behind you taking a buy or a sell decision. I've made 2 videos on this specifically that focuses and tells you how to be focused on a stock and not be focused on the price. It tells you how to be action oriented and not to be price oriented. I'll try and give the link in the description. You can go and see it, or else it's there in the playlist. You can go and check the playlist for those videos. So here is the catch. If you're a seasoned investor, you can jump in and out of the market or of a stock that has caught a public attention like recently. You can do that, but it's definitely not very easy. And it's definitely not easy if you're on your way to becoming a seasoned investor, if you're new in the market. Now, having discussed this topic on how the stock market movement determines or interacts with a person's behavior and forces him to take a decision to buy or sell a security, you might argue stating that, well, no, if I've taken a sell decision and it was a sell at a loss, I think it's good. You might say that. You might argue that the stock that you have sold has never come back up again. You might say, you took a right decision selling it off because the stock went further down, and it just went off. So you took a right call in minimizing your losses and selling off that stock and coming out of the market at the right time, because that stock never came back up. That was the right decision for you. You might argue on that. Well, I agree with you. You win this argument only if you have not sold that stock based on the price movement, and you have sold it based on the fundamentals. You have sold it based on the company strategy, the company position, the company's market status. Now, why am I saying this? The rationale behind me saying this is a stock movement in a moving market can be because of many, many reasons. It can be because of the political reasons, because of environmental factors, because of policy changes, government, and so on and so forth. What not? Company performances, everything is accounted for in a stock price and its movement in a moving market. So here is the important factor. Just as we discussed that a stock's movement is based on market sentiments, the news, the government and political factors, and whatnot. If you just look into these factors and the price of the stock and take a decision, you might miss out on a wonderful opportunity. You might miss out on a wonderful stock and a wonderful opportunity for the future. So the best statement is stop following the herd because you cannot rely on them. We believe personally that you take good time to go through the company's fundamentals, the company's annual balance sheet, the company reports, and then invest in a stock. On the flip side, if you want to capitalize on the short-term movement of a stock, daily trading, swing tradings, and all and so forth, so on and so forth, but you cannot handle the pressure, but you cannot give the time in the market, you have your own job, your own business, then the best strategy, the best solution at this point of time would be to hand over your money to an expert who has excelled in it, who has excelled in day trading or in short-term trading. Because for most of the traders, if they want to grab a stock which has been in the limelight, which has grabbed an attention in the market, actually pays a heavy premium to buy that stock. And of course, missing the benefits that attracted towards it initially. That's all for today. See you again in the next video. Till then, SG signing off. Goodbye.